Okay, once you have taken the count of the stock, you need to now have a feel for at what price or how you value the stock that you are holding. So this is something that can be many methods can come to your mind. One is what is the acquisition or the actual cost at which you had bought the stock, which is also called as historical cost. You can also say I will assess what the selling price of my stock is and then value that stock at that price. And some of you might also say that let's look at what I can sell it at and then lessen all my cost of creating that sale or making that sale happen, and then sell it at what is known as net realizable value. Then let's look at this a little more detail with example, because if you look at straight away expected selling price at which you want to value the stock may not be possible, because you are recognizing the profit without even having sold. How it is happening, how we look at these various possibilities through an example. Let's take that a trader buys two items, he has just two items at a lakh of rupees each, something which is slightly bigger, and therefore he looks to sell only two per year. For example, he could only sell one of those items, but he sold it at lakh and 40,000 rupees. Now the other item of course is stock in hand with him. So what is the profit now? It's a fairly straightforward thing. He bought something at 1 lakh, sold at 1 lakh 40, so his profit should be 40,000 rupees. Now let's look at what happens with the way you value the closing stock, how your profit figure can change. So what happens? We have a sale of lakh and 40. Opening stock, we saw he just started, so he doesn't have an opening stock. He purchased two items for 2 lakhs, and then the closing stock valuation he did at the selling price. As we said, he said I will use the selling price as this. So his selling price was lakh and 40. For the item that not sold also, he looked at selling price as the closing stock price. So what happened? The cost of sales went down drastically, and what you estimated was only a 40,000 rupee profit now has become 80,000. That means he has recognized the profit on this, which is only held with him. So that is why we said valuing your stock at the selling price is ruled out. So let's look at the other option of net realizable value. As I said, this is ruled out. So net realizable value could mean that there is some additional cost I have incurred, say 5,000 rupees in this case, to get the item sold. So my net realizable value will be a lakh and 35,000 rupees. Now will that work? If you look at the workings again, at NRV, we are just reducing the cost from the selling cost from the selling price, and therefore arriving at a cost of sales which is 65,000 rupees. So gross profit again is showing a much higher figure than 40,000 rupees of 75,000 rupees. Now this is to be recognized. Now this is a situation where the price is higher than the cost price of the trader. Now let's look at another situation where the cost price of the trader is higher than now the selling price. The market, there is a slump, and now the trader estimates that he can get only 90,000 rupees for his product, and he is incurred another 5,000 rupees he may incur for actually selling it. So his net realizable value now is 85,000 rupees. Now what does happen now? If you look at it, we will see that the working here remains in the closing stock at NRV after adjusting. Now here is a situation, as I said, the net realizable value has fallen below the cost price, and therefore you will see the profit has also fallen drastically. So from a prudence principle, the valuation of stock should be done at the cost or the net realizable value, whichever is lower, so that we do not overstate profits by looking at either selling price or any price which is net realizable after considering the selling cost, but higher than the cost price. The prudence principle should tell us, or tells us, that we should value the stock at the net realizable value or the cost price, whichever is lower. This is a pretty important concept, because as a part of the prudence thing, many firms tend to inflate their profits through this process, and therefore it's a very important concept to note and understand. Next part comes is determining the purchase price. What do we mean by that? So basically you should understand that in a warehouse or in a store of any firm, lots of goods from various suppliers are coming in and lots of goods are getting issued for production. So when that is happening, you don't know, the prices from the suppliers could be different from different suppliers. The same supplier can give you different batches of the material which is coming to you. Now in the warehouse, you cannot segregate them supplier wise or batch wise and keep it. You keep all the stuff that is of similar nature together. In such a situation, what is likely to happen is that all these are mingled together, which is raw material and finished goods, and you need then to understand how to price the issue. The problem with the storekeeper is that when he is issuing the material, how does he look at pricing that? What price does he take? Does he take the price that was initially incurred or incurred late, the recent price that he has at which he has purchased, and so on and so forth. So this problem we use there are quite a few techniques, but we will discuss two important techniques here. What is known as the first in first out method, where the storekeeper assumes that whatever goods were received the earliest are the ones that are issued. So we will see an example and clarify that even further. And the other is called the average cost method, where as the supplies keep coming in, the average cost is calculated. So you had, say, something at valued at 1000 rupees, and then again a stock for 1200 rupees came in. You add the two, divide by the number of units, and arrive at the average cost. We will see an example shortly, and that also then is the method to use. So one is in the order it has come from the suppliers, it is issued, so that the price is taken in that manner, or otherwise every time a new supply comes in, the average cost is recalculated and the issue is done at that price. Let us take an example and understand this even better. Let us say on 1st November a business held 300 units of an item called, internally coded as 4321, and it was valued at 120 rupees. The details of the 3 batches, now this was the initial stock they had at 120 rupees, and then they received on 10th November, 20th November and 25th November 400 units each, but the cost were different. One was, the first batch was 125, the second batch was 140, and the third batch was 150. And then the sale happened of these finished goods at on 14th November 500 units, 21st November 500 units, and 28th November 100 units. All were sold at a selling price of 200 rupees each. So now what we need to do is to calculate the closing stock at using what is known as the first in first out or the average method, and also calculate how what the gross profit would be. So let's look at how that is done. We have the problem statement here along with the issue dates as well as the sale dates. Now what has happened? On 14th November 500 units were sold. So how will the issue cost be calculated? The first 300 will come from the existing stock, the opening stock that was there, valued at 120 rupees, which gives you 36,000 rupees. The next 200 which was sold would have come from what came in on 10th November, which is the next in line. So 200 at 125 gives you 25,000 rupees. So the issue cost of the sale that happened on 14th November is 61,000 rupees. Similarly, when the 1st November sale of 500 units happened, let's look at what is the balance left out of this 200. 200 has been issued, so 200 is left. So for this 500, the first 200 will come from this batch of 125 rupees, and 200 into 125 gives you the 25,000 rupees being the issue cost. The balance 300 for this particular sale came from the next batch, which is at 140 rupees. So 300 into 140, so the issue price now for that particular sale was 67,000 rupees. Then on 28th November 100 units were sold there. So the balance left out in this, we know that 300 were issued out of this, so 100 was left out, that went at 140, and so 14,000 rupees was the issue cost. So the total issue cost was 1,42,000 rupees, and the closing stock would have been this 400 units at 150 rupees, which is what is shown as 60,000 rupees as closing stock. 400 into 150 is the closing stock figure. So this is how the first in first out method works, and the issue cost of using this method, it works out like this. Let's extend this example and calculate this on an average cost method.